Chapter 3. What is credit? The contemporary credit system is organized in the form of a market on the basis of the principle of liquidity. This principle lies at the root not only of the recent tendency of the financial market to predominate over banking intermediation, but also of the entire financial system since the beginning of the modern age. Indeed, we are not alone in sticking out our necks to claim that the present situation is not simply a particularly intense and prolonged liquidity crisis, but also a crisis of liquidity as the principle governing the organization of the credit system in the form of the financial market. It can be argued, of course, as others do, that this is instead a normal crisis within a business cycle, that we will emerge from it just as we have from previous ones, and that there is no need to call into question the structural elements of the system. But in any case, decisions as to the adequacy or inadequacy of the present system can no longer be taken simply through reference to supposedly incontrovertible matters of fact. If what is really at stake is an understanding and a judgment about the nature of the present financial institutions and their ability to perform their functions, the evidence offered can hardly be limited to pointing out either that they perform well in normal periods or that they are working badly now. Proof is required at another level. In particular, those who wish to maintain that we are faced with a cyclical downturn within an essentially sound structure will have to prove that recovery from the crisis, accomplished with or without the aid of public intervention, will not simply pave the way for another catastrophe, probably worse. On the other hand, those who maintain, as we do, that this is a systemic crisis must be able to provide some term of comparison on the basis of which it is possible to show in what sense the current system cannot perform the function desired by all, namely that of supporting production through the supply of credit in all the forms that production itself requires, whereas a differently structured system could achieve this. The second approach obviously implies that it's possible to speak about credit without identifying it totally and unconditionally with the present form of its provision through the financial markets. The first negative effect of the fetish of liquidity is, however, precisely to prevent anyone from wondering whether liquidity itself is not, by any chance, an obstacle to the attainment of the objective for which it proposes itself as a tool. Is liquidity, the unconditional convertibility between money and credit, the only or the most efficient tool that makes it possible to provide credit in accordance with the requirements of the real economy? Or is it liquidity that prevents us from knowing what money and credit really are, precisely because its structural effect is to make them indistinguishable? If we are not completely wrong to expose liquidity as the problem, it may well be that this effect of impediment is precisely what lies at the root of the market embarrassment currently characterizing both the attempts to explain the crisis and the attempts to indicate a way out of it. In the meantime, however, the crisis itself continues to provide pointers insofar as it is recognized as a crisis of liquidity. A liquidity crisis deprives us not only of credit, but also, in a certain sense, of money, in that money is not spent. Above all, such a crisis tends to reveal that we have no clear idea about the relationship that should exist between the two. If the present crisis has the effect that securities lose liquidity and everyone wants to get rid of them in exchange for money that they will not use, preferring to wait for better times, there is a real risk of these times never arriving precisely because money is not spent. If the liquidity crisis has clearly contracted the availability of credit immeasurably, just as the boom expanded it immeasurably, the real problem is that the measure, which would at least enable us to quantify both the excess of yesterday and the deficit of today, is precisely what is lacking when finance is organized as a financial market based on the principle of liquidity. And for as long as this measure continues to be lacking, it makes little sense to speak of corrections designed to make the economic systems converge, both individually and as an interrelated whole, towards a position of equilibrium and sustainable growth, regardless of whether these are arrived at exclusively through the market and the interaction of private decisions or through the combination of private and public action, for which many are calling again today. If we are to decide whether to intervene in the market and whether such action should be contingent or structural in nature, we need first and foremost to be clear about a certain number of distinctions, which everyone talks about today, but which prove to be hazy both in theory and in practice. First of all, there is the distinction between the short term and the long term, which involves the possibility of assessing both the legitimacy of speculation and the legitimacy of maybe limiting it, with a view to long-term stability. Then we have the distinctions between finance and the real economy, between speculation and long-term investment, and finally between contingent and fundamental variables. Well, while it is to be hoped that all these distinctions will be drawn, they prove at the same time impossible on the basis of the current doxa developed in academic and practical economic discourse. Once again, the fetish of liquidity prevents us from addressing the problem of these distinctions and of their impossibility, precisely because it prevents us in the first place from asking what relations there are between the financial market and credit, between credit and money, and between money as a means of payment and money as a store of value. What can in fact be said about financial markets, and what is actually said, if not in order to reach an understanding, at least in order to cheer us up, on the basis of an unchallenged concept of liquidity? That they are the markets of that particular commodity known as saved money, which, in return for that particular price known as rate of interest, is loaned by those who earn more than they spend to those who have no money but a very good idea of how to spend it, especially for financial investments. The economic growth deriving from those investments makes it possible to pay not only the wages of those for whom they provide work, but also the profits of the entrepreneurs and the interest of the lenders. In short, the squaring of the circle, or simply a slightly more complicated version of Say's law, according to which supply creates its own demand. And therefore all the income not spent on consumption is necessarily invested in such a way as to ensure that the full utilization of resources always obtains in the system. This is, however, precisely the law that Keynes calls into question, on the basis of the fact that capitalist money can be not only spent or lent, but also accumulated indefinitely. We shall return to the possibility of effectively conceiving a form of finance grounded in money that cannot be accumulated when it becomes necessary to speak not only about Keynes' theories, but also about his practical proposals with respect to the financial system. For the moment, we shall concentrate on the first part of the widespread view of credit as the loaning of money by creditors who have saved to debtors who want to spend money but have none. Here we have two elements mixed up with one another, only one of which is really essential. Credit is a loan. This is the essential point, so much so that in some ways nothing else is needed, so much so that no form of economic life is properly worthy of this name without it. Investment entails lending, but then so does professional trading, understood as the dealings of merchants who buy with a view to selling. And for the entrepreneur, in a certain sense, wages too are an advance against the remuneration for what will be produced within the working relationship established with the employee. In short, no matter how they may be regarded, producers are structurally debtors. It is therefore not only that the innovative idea of the entrepreneur, the only one capable of creating new wealth, require credit in the form of a loan, but also that economic life as a whole is based in general terms on the dimension of debt that can never be eliminated, but simply has to be faced. Credit is essential to economic life because it responds to one of its essential and very real needs. The economy of producers, what is commonly known as the real economy, cannot exist without credit. This has important consequences for the present-day debate on relations that should exist between finance and the real economy. If it is true that finance can become independent of the real economy, the opposite is not. The structural debt of the producer must be able to find an equally structural capacity for lending within the economic system. The basic economic problem is therefore to ensure the correct balance between these two elements. Correct in what sense? What is it that must be loaned? The normal and, so to speak, automatic answer to that is that what must be loaned is an amount of money previously set aside. This is, however, one possible form of credit, not its structural form. It's practically tantamount to saying that a loan is inconceivable in the absence of previously accumulated money, whereas the opposite is actually true. Structurally speaking, there's no need for any amount of money in order to create a relationship of credit. The simplest way to borrow is in fact to defer payment, to postpone the settlement of debts. The creditor becomes a creditor quite simply on accepting from the debtor a promise. In order to take place as an anticipation, credit has no need whatsoever of the prior accumulation of money, but rather of the institution of a shared space of promising and waiting, a space in which the debtor appears creditable and the creditor is prepared to wait, a space where the promise and the waiting can meet at a point in time. The space of the promise can in fact be established only with a view to fulfillment of the promise at the moment agreed upon by the parties concerned. As some readers may have noticed, all we've done here is describe one of the most ancient instruments of credit, born in the West under the name of Bill of Exchange during the Middle Ages, and known today as the promissory note. There's no need to represent this form of credit as a trade between present and future money. In other words, it entails no liquidity, but simply deferral, what is referred to in economic jargon as respite for payment. This is granted the debtor solely to the extent that the creditor is prepared to wait, certainly not indefinitely or forever, but for a set period of time. The granting of credit is essential as an advance against settlement. Precisely in order to be what it has to be, however, this advance binds the debtor and the creditor jointly within the framework of the promise. Like trade, credit is essentially not a thing, but a relationship. This relationship has to be seen in itself, that is, prior to and independent of the contractual forms in which it has taken specific shape historically. In other words, the task is to pinpoint its basic economic feature. From the viewpoint of a phenomenology of finance, this is its intrinsic riskiness. If it is true that credit has to do with promises, the ability to make and accept promises can never in itself guarantee that they will be kept. The truth of promises runs up against the possibility of non-fulfillment, of the debtor proving insolvent. Once again, this is a structural matter. No debtor, not even one who borrows with a view to production, one really lacking what is needed in order to undertake an economic activity, can be totally sure of being able to pay in accordance with the terms agreed upon. The promises accepted by creditors are in fact as risky for them as economic undertakings made possible by this credit are for debtors. Even if the decision to borrow is made on the basis of the most prudent and realistic of business plans, entrepreneurs can never have completely certain foreknowledge of the economic conditions in which they will find themselves operating once the investments are made. A sudden and unforeseen drop in the prices of the goods they intend to produce could make entirely unprofitable a project undertaken on the assumption, entirely reasonable at the time, that there would be no change in the trend of prices. It should be noted in passing that this is the condition in which producers risk finding themselves today. As has been stated, in paradoxical terms, the only certain way for debtors and creditors to avoid risk is quite simply to borrow and lend nothing at all. Risk is in fact bound up with the very structure of credit. The loan granted now will be repaid at a later date, which means in economic conditions that not only cannot be predicted with a complete certainty, but also prove radically resistant to exhaustive measurement in terms of profitability. Insofar as it involves a relationship with the future of economic relations, credit knows no certainty. Risk is inherent in the relationship because the relationship is structurally suspended over a fundamental uncertainty. Moreover, as it is the relationship itself that entails the risk, this cannot properly be borne by just one of the two parties involved. Debtors must, of course, be able to anticipate extremely well the conditions of their solvency, just as entrepreneurs are true to their name and truly courageous when they are not afraid to take risks, but at the same time they avoid entanglement in plainly reckless or unrealistic plans of investment. Conversely, shrewd creditors must be able to assess the credibility of those seeking funds. If a bank is to perform its real function as a financial intermediary, it must in this sense be capable of rationing credit and of granting it only to those it judges capable of meeting the commitments undertaken, for instance by distinguishing between prime and subprime borrowers, more and less safe debtors. These are, or rather should be, the basic tools of the trade on both sides, and their possible shortcomings are precisely what bankruptcy law has to deal with. Even though each party will obviously be tempted to shift onto the other as much as possible of the burden of uncertainty, and thus to make its position more sustainable, also with respect to its own errors of evaluation, the fact remains that this burden can never be wholly resolved in a calculation of risk. The burden of the fundamental uncertainty characterizing their relationship is something to be shouldered and borne by the debtor and creditor together. It is precisely because he did not fail to take all this into account that Keynes was able to identify the relation between the creditor and debitor as the very foundation of economic activity, the basis, or rather the indispensable prerequisite, of every real economy. For the same reason, this relationship is also the framework within which the necessary relationship between the financial economy and the real economy is established. We are, of course, speaking here not about the risk, but about the uncertainty. The difference between the two is one between what can be reasonably assessed and what eludes the effective and concrete possibilities of prediction. Where the calculation of probabilities is possible, insurance against the risk calculated in this way is possible too. Also possible is the development of a specific profession characterized by the ability to assume risk on behalf of others. In this perspective, and within the limits set by the calculability of risk, speculation can be seen as a form of insurance, and thus as constituting an element of market stabilization and a factor of growth for business transactions. But what are the limits of calculability? The question is highly delicate and calls for close attention on the part of any study of the economy wishing to be regarded as scientific. The ever-present temptation is, however, to ignore the problem and to construct credit institutions as markets pure and simple, on the basis of the dogmatic assumption that everything can be calculated, and that the interaction of speculative dealings removes all uncertainty from the relationship of debt and credit, at least asymptotically. It is on this skewed plane that liquidity assumes its whole relevance in history. The illusion guiding this dogmatic construction is that of a financial market whose increasing liquidity and completeness, or whose endowment with sophisticated tools for the calculation and the negotiation of every type of risk, is directly proportional to its capacity to eliminate uncertainty, first of all for creditors, but then, indirectly, also for debtors. As creditors who are certain about getting their money back at any time will lend capital more readily, debtors will also be able to enjoy increasingly easy access to credit. This illusion, which goes by the name of the democratization of finance, has recently been expressed with a dogmatic forcefulness that leaves no room for doubt. The goal, as some have literally said, is to arrive at a position where credit can be granted also to those who do not deserve it, namely the structurally insolvent, the subprime borrowers, also known improperly as the poor. Even assuming that this is not an illusion but an operatively manageable situation, we must however ask whether this objective is desirable economically, not to mention morally or anthropologically, and whether it really enables the economic system that achieves it to strengthen its basis. A sound economy, probably one capable of less explosive growth than the economic miracles to which we have become accustomed, but also one of less severe and protracted depressions, should perhaps be able to ground itself on the acknowledgement of the solidarity that must reign between creditor and debtor. Nor has such solidarity any need of interpretation in bleeding heart terms, as it is in fact capable of developing at a strictly economic level in the form of a sharing of the burdens of adjustment, which the uncertain change of economic conditions requires towards the effective payment of debts. Keynes at least thought so, one example being his suggestion that the model for the debtor-creditor relation should be a marriage, the union from which it is permissible to derive all the pleasure as long as you are prepared to face whatever fate may bring. To take the metaphor a little further, the radical alternative to matrimony, and one that also offers more pleasure in the short run, is the large-scale orgy, a way of organising interpersonal relations that is based, let's say, on the fact that they can be broken off at the drop of a hat. While it would be interesting to see how often the term orgy crops up in relation to the financial markets, we have no wish to trust so completely the evocative power of the metaphor. This is simply a matter of recognising that the debtor-creditor relationship possesses a basic indissolubility, which no detour through liquidity can really eliminate. It should not be forgotten, however, that the advocates of financial innovation, and especially of derivatives, have maintained precisely this, that there exists, at least asymptotically, a situation of the financial market in which liquidity, by distributing risk through the market, can guarantee something very similar to the disappearance of uncertainty. Above and beyond all metaphor, what is at stake is actually institutional in character. If the uncertainty inherent in the debt-credit relationship could truly be resolved in a set of calculations, it would then be possible, and indeed legitimate and necessary, to conclude that credit as such is a commodity like all others, hence one whose price depends exclusively on its conditions of supply and demand. If this were so, the financial markets would indeed make the most suitable and the most efficient institutional framework for credit. The interest rate would not be simply a parameter serving to assess the liquidity of assets, but in all respects the measure, that is, the price or rate of substitution, guaranteeing equilibrium between the supply of credit and the demand for credit. And credit would essentially be nothing but an intertemporal trading of actual money. No relationship would survive the possibility of treating credit as a thing. One small problem would remain, however. How are we to explain, without resorting to human frailty and the virtus dormitiva of Molière's celebrated physicians, not only the crises that have marked the history of the financial markets ever since their birth in the 17th century, but also their increasing intensity and frequency precisely when the dogmatic decision to treat credit as a commodity has swept aside all opposition and the trend is towards the abolition of all restrictions on international capital movements. Moreover, if credit were by its very nature nothing but a commodity, what are we to say about the fact that credit has proved historically possible, and this even without assigning the interest rate a central and institutional role as the balancing price between demand and supply of money? What are we to say, in short, about the forms of institutional organisation of the debtor-creditor relationship which seem to respect the fundamental uncertainty characterising it? One way out would be to declare them forms superseded by evolution and innovation, on the wholly unproven assumption that innovation is synonymous with improvement. What is known as Islamic finance would appear to meet the demand for self-persuasion on the part of the pro-market doxa. Islamic finance is supposedly nothing more than a residue of inferior organisational form grounded on the prohibition of lending at interest, which is in turn grounded on moral prejudices indicative of cultural backwardness. Despite the fact that more than one objection could be raised against this self-serving representation, there is, however, no need to look outside the Western economic tradition in order to find forms of credit closely akin to the basic principles of Sharia-inspired finance. One example is venture capital. In the contractual form of the commenda, venture capital, or the partnership between a party with money but no ideas and an entrepreneur with ideas but no money, constituted a formidable stimulus for the recovery of international trade from the 13th century on, and at the same time it was judged to be compatible with the legal prohibition of lending at interest. The basic rationale of the contract is simple. The combination between money with no purpose and a purpose with no money makes possible an activity that is intrinsically risky, but for this very reason also potentially profitable. When venture capital does not take contractual forms so asymmetrical as to eliminate all risk for the creditor, which was always historically possible but not for this reason necessary, what is jointly shared in a relationship of basic solidarity is both the risk and the gain. The capital makes a profit if the business does, and not independently from it. The parties give each other gratification and support, but cannot unilaterally exempt themselves from risk. The formalization of this type of credit relationship owes a great deal to 14th century Franciscan theology. Multilateral clearing also rests on the same principles of solidarity. To put it very simply, given that we shall return to clearing in parts 2 and 3 of this book, the idea at the root of the principle of clearing is that liquidity is not necessary. In other words, there's no need for a predetermined amount of money to be exchanged between debtors and creditors in order for trade and investments to become possible. A clearing system is created in order to meet the need for advances without requiring any previous accumulation of money for this purpose. It simply makes it possible to register 1. A debt owed by someone who is required to make a payment but who cannot do so immediately, and 2. The corresponding credit in favour of the party to be paid. This is, however, from the very outset a trilateral rather than bilateral relationship. Both sums are registered as debit or credit with respect to the system as a whole. In virtue of its tripartite structure, the system permits the use of credits to make payments also towards third parties. In this way, credit and debit are not individual and fungible positions, but acquire their meaning in relation to the entire set of relations constituting the system. Within a clearing system, credit takes the form not of a bilateral relationship represented by a negotiable security, but that of a net position, positive or negative, of each member with respect to the set of all the others. What ensures the actual clearing, in other words, the effective meeting of debtors and creditors, is therefore not a price, a rate of interest, such as to balance the supply and demand of money, but rather the multilateral compensation of profits and losses and the tendency to converge towards parity for all the participants. Clearing thus ensures all the advantages of liquidity, but without liquidity being taken as the cornerstone of the system of relations. Far from being a relic of a past evolutionarily superseded by financial innovation, the principle at the root of the above-mentioned operative possibilities, and presumably of others too, is one that still awaits exploration. Above all, it shows that the dogmatic operation of reducing credit to a commodity is neither self-evident nor necessary, and indeed a dogmatic operation it is, both theoretically, Say's law and its possible transformations, and at the level of practice, the organisation of financial markets on the basis of liquidity. Moreover, insofar as these forms of credit provision do not entail the presentation of credit as a loan of previously accumulated money, they raise the problem of the nature of money and of its relationship with credit. But that is the subject of the next chapter.